Okay. Okay, good morning, everyone. Can you hear me?
All right. Yes, we can hear you.
Okay, great. So first of all, let me thank Jesse, Brent, and Matteo for putting together what I think is a great initiative. I'm very excited to be part of this. And together with Wenjin and Adrian, we'll be kicking things off by talking about currency markets this morning. And what I'm going to do is sort of provide you a big picture overview of the research that's been happening sort of at the frontier of asset pricing and international finance and thinking about exchange rates. And in some sense, you could argue that what we've seen here is sort of a giant exercise in intellectual arbitrage, but I think it's paid off. And so hopefully I can get you excited about what we've learned over the past few decades in thinking about exchange rates, taking an asset pricing perspective. The starting point of my introduction is going to be that currency markets and bond markets are obviously tightly connected. And in fact, a big part of what exchange rates have to do on a day-to-day basis is to sort of continuously adjust to make sure that returns are kind of aligned with risk, both for domestic bond market investors and foreign bond market investors. And once you take this perspective, you kind of quickly see that exchange rates in currency markets are going to be priced much in the same way as stocks are priced in equity markets, and they're going to reflect a bunch of different forces. Exchange rates are going to have to absorb shocks to future interest rates, and you can sort of think about that as the cash flow component that accrues to an investor who takes a long position in foreign currency. It's also going to reflect news about future discount rates, and these are deviations from uncovered interest rate parity. In other words, foreign currency risk premia. That's the second force. And then there's potentially a third force that is going to come into play, which is deviations from covered interest rate parity, and that's going to reflect things like convenience yields because of safe asset demand, balance sheet constraints that are experienced by financial intermediaries. Matteo already alluded to that in his introduction. All these three different forces together will jointly sort of determine the level of exchange rates. And so the way we've organized things is I'm going to sort of broadly outline this framework to think about exchange rate determination. Adrian is going to focus on deviations from uncovered interest rate parity and foreign currency risk premia. That's going to be the second part of today's session on FX markets. And then Wenjin is going to come in and talk about deviations from covered interest rate parity. And she's obviously an expert on this and has done quite a bit of research on this very topic, both with Adrian and with Jesse, one of the co-organizers of this initiative. Okay. What we're going to find, what's going to come out of this at the end of the day, is we're going to find that shocks to discount rates, deviations from uncovered interest rate parity, are actually responsible for a large share of variation exchange rates. If you understand variation exchange rates, these shocks to discount rates are going to be particularly important. And this force is something that we've only really studied carefully in the past few decades. So that's kind of the sea change relative to the work that's come before. Okay, so let me jump right into it. I'm going to start by outlining what the relation is between the exchange rate today and short-term interest rates. And once we've done that, I'm going to switch gears and talk about the relation between exchange rates today and long-term interest rates. And then the third part of the discussion is going to focus on exchange rates and deviations from covered interest rate parity. As I said, I see my job here as sort of mostly being the warm-up act for Adrian and Wenjin, so I'm not going to go into too much details about the data and the empirical evidence. I'm going to let Wenjin and Adrian do the hard work. Please stop me if something's not clear or if you have questions. So what I want to do to derive this relation is sort of go back and start from the basics. We're going to look at the Euler equation of a foreign investor with a pricing kernel or stochastic discount factor M star who's thinking about taking a long position in US bond markets. If she does so, she can earn a yield Y dollar on that long position in treasuries. She could alternatively decide to invest in her domestic bond market, earning a yield Y star. Okay, we're going to enforce both of these Euler equations and then explore what that tells us about the exchange rate. Note that the exchange rate plays a prominent role in that first Euler equation. S here denotes the exchange rates in units of local currency per unit of foreign currency. So an increase means an appreciation, okay? What we're going to do is we're going to take these two Euler equations and sort of work out the implications for the exchange rate to keep things simple. This is not essential, but we want to keep it sort of simple and tractable. We're going to assume joint log normality of exchange rates and the pricing kernel. Lowercase symbols here are going to denote logs, okay? And so if you work out the math for these two Euler equations, you're going to get two fairly standard expressions that involve the mean of the log stochastic discount factor, the conditional variance, and a covariance term, which is the risk premium. So the currency risk premium is going to be minus the covariance between the foreign log stochastic discount factor and the rate of appreciation. Okay. All right. So now if you combine these two Euler equations, a bunch of things cancel out, and what you end up with is the following intuitive expression, which says that the rate of expected appreciation of the dollar plus the interest rate that a foreign investor will capture when she's going long in dollars and short in domestic currency. So that's Y dollar minus Y star. That is the log currency risk premium, okay? Now you can rewrite this equation as a difference equation for ST, for the dollar exchange rate. The dollar exchange rate is on the left-hand side in that equation, and now it's going to reflect the future exchange rate, again in logs, plus the interest rate difference, minus that currency risk premium. This is kind of the central equation. What you can do here is you can keep iterating on this equation and sort of roll it forward. What comes out of that is what I'll call the fundamental exchange rate valuation equation, which says that the dollar exchange rate, and so here we're looking at the dollar in terms of foreign currency per dollar, is going to reflect future interest rate differences minus future currency risk premia, plus this sort of nuisance tail term, which reflects your expectation today of the exchange rate in the distant future, okay? This equation was sort of originally derived by Campbell and Clarita back in '87, but was really used more recently by Fruit and Romotorai to sort of think about the determinants of exchange rates. Key thing to point out here is that this actually will hold very generally. So note that we really haven't made too many assumptions about the market structure. All I've assumed is that these bond investors' Euler equations hold, both for the foreign bond and for the US Treasury. But other than that, I really haven't made any assumptions. Particularly, I'm not assuming that markets are complete, so I'm not imposing that the foreign stochastic discount factor equals the domestic stochastic discount factor times the ratio of exchange rates. This is only the case if you assume that markets are complete, and Adrian will come back and talk more about that. So this equation here is much more general than that. There's really two main forces here that we need to think about. The dollar exchange rate today is going to reflect a cash flow term and a discount rate term. The cash flow term in blue is the difference between short-term interest rates in all future periods. It's the dollar interest rate minus the foreign interest rate, okay? And the discount rate component, that's that currency risk premium. That's the deviation from short-run UIP. So if you were to impose uncovered interest rate parity, the red stuff would disappear from this equation, and you'd only be left with these interest rate differences and the tail. Okay, so let's kind of think about what this means in terms of, you know, how changes in interest rates will affect the dollar exchange rates. Well, what you can tell by staring at this equation is that the dollar will tend to appreciate. That is to say, ST will go up when US interest rates in the future are expected to increase. That's very intuitive. As we said, for a foreign investor who takes a long position in the dollar, the cash flow component is exactly that interest rate difference she's harvesting. And so if you're going to increase US interest rates, that means that the cash flows are going to go up. On the other hand, if you increase the risk premium that a foreign investor demands for holding dollar currency risk, that's actually going to push the other direction, and that's going to cause the dollar to depreciate. Okay, so these are kind of the two main forces that are going to determine exchange rates quite generally. So the key thing to realize is that this fundamental exchange rate valuation equation is going to hold across a very large class of models, both complete and incomplete market models, and even models in which markets are somewhat segmented, okay, which recently we've seen quite a bit of work on that in currency markets. So it's quite general, okay. And just sort of intuitively, it's kind of interesting to think about, say, a country like Switzerland or Japan that sort of has consistently low interest rates. So now let's switch gears, take the perspective of, say, the yen versus the dollar, or the Swiss franc versus the dollar. So what's going to be the determinant of the yen exchange rate? Well, it's going to be that interest rates. It's going to be yen interest rates minus dollar interest rates minus the currency risk premium. And what you can sort of tell from staring at this is that, well, if Japanese interest rates or Swiss interest rates are going to be consistently lower than US interest rates, then in order for the exchange rate to sort of be stationary, that's going to have to be offset by small or even negative currency risk premia, right? And that is kind of what you see in the data. You see that there are persistent interest rate differences, and Adrian will document this at length across developed and emerging market countries, but they seem to be mirrored by offsetting foreign currency risk premia. And so what the Swiss and the Japanese effectively have done is they've convinced currency market investors, well, yes, we offer lower interest rates, that's true, and that's probably going to be true in the future, but we're safer currencies for you to invest in. We have potentially a negative beta. Conversely, high interest rate currencies, they're perceived to be riskier by bond market and currency market investors, and they tend to earn higher risk premia. Okay, so you get this sort of nice offset between these two components in the exchange rate valuation equation. Okay. All right, so that's kind of the key exchange rate valuation equation that I want you to keep in mind as we go through the first session and you go through the material that Wenjin and Adrian will present. Second thing I want to do is sort of address the following obvious question. Well, you've sort of seen now what the relation is between exchange rate today and short-term interest rates. What can we tell you about long-term interest rates? Well, it turns out, using exact same logic, you can actually derive a simple relation between exchange rates today and future long rates. Okay. So now we're going to sort of modify that fundamental exchange rate valuation equation, and we're going to decompose the exchange rate today into a long rates component. That's going to be the cash flow component. So instead of short rates, we're now going to look at long rates. There's going to be a second component that captures deviations from short-run UIP as before, but now there's going to be a third component which captures deviations from the expectations hypothesis in bond markets. So if you go back to your basic finance, you'll remember that the expectations hypothesis sort of says that if investors are risk neutral in bond markets, then the expected excess return on a bond of any maturity ought to be zero, right? So it's the equivalent of uncovered interest rate parity in currency markets. What I'll show you, and this is kind of, I think, a neat and intuitive result based on some of the work that I've done with Adrian and Andreas Statopoulos, and also some work that Mike Chernoff's done with Nina Boyarchenko and Dave Backus. When exchange rates are stationary, so when there's no long run risk in exchange rates, when they kind of revert to a mean, then the second and the third component will always have to cancel out, and you get to something that we'll call long run uncovered interest rate parity, okay? So that's gonna be what comes out of this. So this is the only part where you have to bear with me. This requires a couple of steps, but they're actually fairly obvious. And so if this goes by too quickly for you, please stop me and we can sort of spend a bit more time on it. I want to think about bond risk premia real quickly now. We're going to define the log holding period return on a maturity and bonds. These are zero coupon bonds, just as the difference between the price tomorrow or next period of the bond minus the price today. Of course, next period, the bond has a maturity of n-1. To keep it simple, you could think about the maturity as being denoted in years here. Well, if you look at the definition of the holding period return, and this goes back to work by Campbell and Schiller, by the way, then you see that you can iterate forward again to express the log price of the bond today as minus the sum of the holding period returns that an investor is going to earn over the maturity of this bond. So if this were a 10-year bond, you look at the holding period returns over the next 9 periods that this investor would earn. Similarly, we can derive an expression for the yield as the average holding period return over the maturity of the bond. Okay, so now why is this useful? Well, what we can do now is we can say, okay, I'm gonna look at excess returns, the holding period return minus the short-term interest rates. And now I can write that sum of short-term interest rates, which we care about because that's what I had in the fundamental exchange rate valuation. I can rewrite that as long-term yields minus bond risk premia, okay? And I'm gonna plug that into the blue component of the fundamental exchange rate valuation, right? So I have a new expression for that first term in blue by substituting for the sum of the interest rates. And what you get then is actually fairly intuitive, okay? So bear with me here. I know this was probably a lot to digest, but I think what you'll see here is gonna make perfect sense. So the dollar exchange rate now is going to reflect not short-term interest rates, but the long-term interest rate difference, okay? So it's gonna reflect the difference between, say, the yield on a 20-year US bond and the yield on a 20-year German bond, okay? Plus the difference in bond risk premia, okay? That's that second term. And I've labeled that deviations from the expectations hypothesis. Those will come into play. And then there's the third term that you're familiar with, which we had before, was deviations from short-run UIP, okay? The last term that one's just going to converge to the unconditional mean if the exchange rate's stationary. So now we've got a relation between exchange rates and long yields. Okay. What does this mean? Well, let's sort of go over the different forces that are driving the exchange rate here. This says, look, the dollar is going to appreciate when long yields at the long end of the yield curve go up today relative to foreign yields. That's intuitive. That's sort of like the cash flow component becoming more appealing for a foreign investor. The dollar is also going to appreciate when the local currency US bond risk premium, which enters with a minus sign, goes down. Okay, so that's that RX dollar N minus J component. That's also intuitive. And it's going to appreciate when future dollar foreign currency risk premia, the term in red, decrease. That's the force that we talked about before. So now you can sort of see that currency markets and bond markets are really intertwined, right? And that bond risk premia are going to have sort of a direct effect on the exchange rate. And now the interesting thing that I wanted to draw your attention to, and hopefully this will help you develop some intuition, is suppose now that you thought exchange rates are stationary, and in particular when you're thinking about the real exchange rate, that seems to be a natural assumption, and some of the speakers later on in this program will come back to that. It's natural to think that real exchange rates sort of revert back to some long-run mean. That being the case, you can show that the second and the third component are actually going to exactly cancel out, and that the only thing you end up with is sort of the deviation of the dollar exchange rate today and deviation from some long-run mean is just going to be pinned down by long-term interest rate differences between, say, the US and Germany, okay? So you kind of get this exact offset. Why does that happen? Let me try and give you the intuition for that. Well, you essentially get long-run uncovered interest rate parity being restored. And that sort of has to happen because if exchange rates are stationary, then in the long run, there's no risk for an investor, no additional risk from investing in a US bond relative to a foreign bond. And hence, it's as if in the long run, that investor is sort of risk neutral. And lo and behold, you sort of get back to long run uncovered interest rate parity. Okay. Now, why am I spending time on this? Well, this is actually a bit more than sort of of theoretical interest. Why? Well, because first of all, we tend to think, especially if you're thinking about real exchange rates, that this is a reasonable description of the data for a large set of currencies. But there's also evidence to suggest, actually, if you look at currency markets, that high currency risk premia are offset by local currency bond risk premia, and that long run UIP is sort of a good benchmark model to think about exchange rates. And in fact, recently there's work by Gurenshaw, Ray, Vayanos, and Greenwood, Hansen, Stein, and Sundaram that sort of builds models that implement a version of long-run UIP. And there's references to the literature if you're interested at the back of the slides. Real briefly, I'm not going to talk too much about this because I don't want to steal Adrian's thunder, but it does seem to be true that in the cross-section, there's no currency carry trade to be earned. That is to say, if you're going to go long in longer maturity bonds of countries that have high interest rates, let's say Australia, and short longer maturity bonds of countries that have low interest rates, like Japan or Switzerland, that is actually not going to give you a large excess return. Why not? You're probably thinking, well, it's because the foreign currency risk premium, which is low or negative for the Japanese yen is going to be offset by a higher term premium, okay, or a bond risk premium that's higher. Similarly, in Australia, what you tend to see is that the high currency risk premium that you get as an investor going along in Australian currency tends to be offset by a low or negative bond risk premium. And so at the end of the day, chasing high interest rates at the long end of the yield curve doesn't seem to pay. And that is, as I said, that's consistent with the evidence in favor of long-run UIP and long-run purchasing power parity as well. And there's earlier work by Meredith and Shin and Budok, Richardson, and Whitelaw that sort of hints at the fact that long-run UIP is probably sort of a reasonable way to think about what's going on in the data. So let's go back to this equation. What this equation kind of says is something pretty radical, right? It says, well, if you had yields at the really far end of the long end of the yield curve, they should sort of totally span exchange rates. If you ran a regression of changes in exchange rates on changes in these very long-term yields, you should be able to explain all of the variation. That's not quite true. In fact, there's a recent paper by Mike Chernoff and his co-author Drew Creel that kind of shows that actually these R-squareds are probably on the low end. So that's kind of an interesting thing to think about, but bear in mind that if you believe in PPP and long-run UIP, then long rates should really explain a lot of the variation in exchange rates. Okay. Real quickly, I'm not going to go into too much detail here in the interest of time, but I just wanted to highlight that sort of the canonical asset pricing models that we have, let's say a habit model and a long-run risk model, when they're adapted to sort of match moments of currency markets, this is one set of moments they're going to struggle with quite a bit. You won't have this sort of long-run uncovered interest rate parity driving an offset between bond risk premia in local currency and currency risk premia, because in those models, you get permanent shocks to real exchange rates and deviations from PPP. They're sort of built in to these models. And unless you shut those down, you can't get that. Long-run UIP is not going to hold because, well, there is long-run risk in exchange rates in these models, okay? As I said, there's some more recent work, for example, at the NBER, the Summer Institute, this work by Gorinshitz et al. And Greenwood et al. That was presented that sort of delivers segmented bond market models. They don't try to price equities. That actually doesn't suffer from this particular problem, and that sort of enforces long-run UIP. Just intuitively, how does all of this work? Think about an increase in the supply of long bonds in the context of a model like that. Well, what happens there is that US arbitrageurs demand a larger bond risk premium because they're forced to hold more risk now. That's going to drive an increase in US dollar long yields. Then the US dollar is going to appreciate right away to offset the effect of the higher dollar yields, right? So that's consistent with that equation that I just showed you. Just in terms of magnitude, suppose that the 20-year yield goes up 5 basis points. Then we expect a 5 basis point per annum appreciation of the dollar over the next depreciation, excuse me, of the dollar over the next 20 years, which means that the US dollar is going to appreciate by 100 basis points now. How does this all work out? Well, the way this works is, as I sort of hinted at, the increase in bond risk premia in the US is going to be completely offset from the perspective of foreign investors by decrease in foreign currency risk premia, okay? And the intuition is that, well, in the long run, the foreign investor here doesn't need a higher return for holding long US dollar bonds because there's no long run risk. She understands that the dollar is just going to mean revert back to its long run mean in the long run. Okay, so these sort of newer classes of models impute an important role for quantities and flows in determining exchange rates. And of course, there's other work, for example, work by Xavier Gebex and Matteo Maggiore, that sort of similarly imputes a role for quantities and flows and exchange rate determination, which more standard, classical complete market models didn't have. Okay. So that was a bit of a detour to think about the relation between exchange rates and long yields. Now let me conclude by thinking about exchange rates and convenience yields, which is kind of the third major force that I wanted to highlight in the determination of the exchange rate, and then we're done. Okay. So let's go back to the Euler equations we started from. Remember, that first equation is the Euler equation of a foreign investor who's thinking about going long in US Treasuries. But now let's assume that this investor gets a convenience yield lambda dollar star from a long position in Treasuries, okay? And we're gonna think that that lambda dollar star is pretty big. That German investor or that Italian investor has particular safe asset demand for dollar denominated safe assets, and US Treasuries are kind of the best game in town when it comes to safe assets, okay? You go through the same steps, but now you have these convenience yield terms, these lambdas floating around. You do the same math that we did before, where you iterate on this different equation, and you iterate it forward, and now you come out with sort of an amended fundamental exchange rate valuation, which has a new component in green, and that is the difference between the convenience yields a foreign investor gets from a long position in Treasuries, lambda dollar star, and the convenience yield she gets from a long position in, say, German bonds, which is lambda dollar, okay? And so as the perceived convenience yields in the future from Treasuries go up, the dollar is going to appreciate. That's quite intuitive, right? What you want to do to sort of restore equilibrium is when that foreign investor gets a higher convenience yield from holding Treasuries, you want the dollar to appreciate right away to generate an expected depreciation in the future and thus lower the perceived return for that foreign investor from holding a long position in dollars, right? So just to summarize, we're now sort of back where we started, but we've got this additional new component that reflects deviations between convenience yields earned on Treasuries and convenience yields earned on whatever the foreign equivalent is, okay? Now, of course, this equation is sort of not that helpful unless we have a good way of measuring what those convenience yields are exactly. And this is where I'm going to lean on some recent work by Wenjin and her co-authors, in particular Jesse, as well as some work that I've done with Zhenying Zhang and Arvind Krishnamurthy. If investors earn differential convenience yields in Treasury markets, then CIP cannot hold. That's kind of intuitive, right? Because if you get these non-pecuniary benefits from holding US Treasuries that you don't get when holding bonds, then there's no sense in which covered interest rate parity ought to hold. In fact, you're going to get deviations from covered interest rate parity. And that deviation is going to help us pin down exactly what lambda dollar minus lambda star is, okay? In particular, the Treasury basis, and Wenjin is going to talk in a lot more detail about this, you can define it as the difference between the yield on a cash position in Treasuries and the yield on a synthetic Treasury that you construct from a German bond, but you hedge the risk, okay? The idea is that the cash Treasury position from the perspective of that German investor is really a lot more appealing, offers more convenience yield than a foreign government bond, and that the basis is going to reflect that, right? So if you increase lambda dollar, that's going to show up as a more negative basis that is going to lower the cash yield on US Treasuries relative to the synthetic yield on a treasury that you've constructed by using the German bond. And so what you can do is sort of use the CIP deviations and kind of plug them in there, in that green term right after the equality sign. And so you can give empirical content to the notion that safe asset demand is going to drive the rate of appreciation of the dollar. And there's some evidence we found in our work that, in fact, when investors think convenience yields go up, that's going to be reflected in an appreciation of the dollar. Interestingly, Matteo talked a little bit about this, and Wenjin will come back to this, but during the recent COVID crisis, this force hasn't been quite as strong as it was during the financial crisis. Big component of why that is probably these swap lines that the Fed sort of immediately put into place. They're quite large, to the tune of $500 billion, if I'm not mistaken, to alleviate the shortage of dollars and presumably sort of mitigate the impact of lambda dollar on the dollar exchange rate. Okay. Let me briefly conclude by sort of outlining that once you have this equation in place, you can think about things like quantitative easing. How is that going to affect the dollar exchange rates? Right. Well, then you have to sort of try and sort through how is that going to affect these convenience yields, right? When the Fed buys treasuries, is that going to increase the convenience yields because you're creating scarcity? These are all things that you can think through, and you can use this equation sort of logically to sort out all of these impacts. So I'm actually just about out of time. So I think this is a good point for me to conclude where I started, which is, hope I've convinced you that this sort of asset pricing view of exchange rates is kind of useful. And it really outlines three major forces that Adrian and Wenjin are now going to talk about in more detail. The first one is sort of the cash flow component. That's the standard component that much of international finance was thinking about until a few decades ago. Recently, we've done a lot more work trying to understand the second component, discount rates. And then much more recently, over the past 2-3 years, I'd say we're thinking more deeply about deviations from covered interest rate parity, which will reflect convenience yields, but also binding balance sheet constraints for financial intermediaries and other forces, and Wenjin will tell you much more about this. So I'm going to conclude right here. I think we're sort of right on time, and I'll hand the floor to Adrien.